All right, good evening, guys. Canna Tortoise Capital, strategy podcast for Sunday night, March 29th, 2020. I'm going to go through the daily weekend and then the daily reports pretty quick, and then I got some other material to cover if you want to hang around. So, bearish volatile. We've pulled out of the oversold. Risk Z is rolling up. That favors the swing trade, but carefully because we've moved 15% off the low and people have money to preserve now in the short term. We'll be rotating blended month rebalancing systematically this month, or this week, I should say. ETF2s at 0%. Monthly checks, we have just dipped into the fall, getting ready to come out of the Red River. So that is, the long-term buy and holders think they've done enough. I don't think they have. But this monthly move has been a system shock of the last 100 years. Last time was the Great Depression. People were talking about the world coming to an end here, and it went twice as long. So this was like a 7 sigma move, and it came out of the Z3 channel. It came back above fair value. It was at 1.5 Z here. 3 support levels at Z-2, fair value Z-3, and then the price ladder on the way up. So the long-term buy and holders are nervous, and properly so. Short-term, or the midterm, I guess the weekly, again, it's gone from Z+2 to about Z-5. If you look back to how far this would have been from that period, extraordinary. So it got outside the Z3 lines even after the width of the Bollinger Band channels doubled. But the rebound was significant, closed well. On the way up, these are just the Z3, 2, 1, 0, plus 1 price ladders. And then this acts as resistance here at about 255. The previous belly of the dragon, which is where it bounced Friday and pulled back. So, but we just dipped into the winter. So this is shorter-term volatility. So if the long-term guys are alert, the shorter-term guys are very nervous still, and properly so. Daily, we've got the P1. So we have this is basically preparing to be an owl entry if it crosses above the thick green line, which is the 10-day high and the 2-day high, and an owl entry. On the downside, it's the edge of the dragon, belly of the dragon, RL30. RL10, and then the absolute swing low, which is the 10 and the 30-day lows. Here's the 1-day, 10-day, and 30-day trading periods. Price is at about 30% from the swing high. The Red River is at minus 41 on the MACD line, well outside the Red River, but it did roll into spring, and so hope does spring eternal. Everything got smashed except treasuries, with a couple key exceptions. What I mean by this month that they have gotten smashed. But the clear winners were in the U.S. real estates, utilities, real estate, industrials, and energy. And I think that's just because of nobody can see the price going much lower. And last time I checked, we're still going to need energy to survive. So the industrials. Financials did well, but not as good as some of the other sectors. Emerging markets at plus 9%, and technology at plus 8.5%, all lagged the basic materials. So this was betting on Main Street and not the tech growth sector. So this is betting in the core competencies that'll get us out of the gutter. Same thing on the broader ETF 32 and the Dow 30. Nike, American Express, United Tech, Boeing on beliefs in a bailout. Walmart is the anomaly for me. Sector spiders, big winners, again, utilities, real estate, Industrials, insurance, and aerospace, home builders, metals, and mining. So kind of the front end of the economic rebuilding of the industrial base. That's consistent with my simple theory. U.S. is in generally better shape than Latin America and Europe. There's still some choices up here in the S&P 500 and XLK that have possibilities. All the defensive plays here, the emerging strength in shorter-term bonds. Shifting to the daily. 10-day max pains. Walgreens, Walmart, Boeing, Chevron. I think those are some quality on deep discount. Fully valued. Travelers, Home Depot, Diamonds, McDonald's. Simon Property Group, Devon Energy, Halliburton. Those are that Max Payne and Simon Property Group to me looks like really risky going forward as a sector. I still think that one, commercial real estate for small businesses is just going to get squeezed between the people who need bailouts, and so they're voters, so there's a constituency to protect them, and then the banks. And the super large caps have been well taken care of. It's that smaller business and rent collectors on the commercial side that are kind of getting squeezed here. And it doesn't matter to the nation if they go out of business, because the banks will be cash flush and they and the Fed will be buying up all sorts of properties. So I think the commercial real estate's the area that's going to get squeezed. In the Dow Tactical, plenty of dojis on Friday. Was an inside day on declining volatility. Coke and Walgreens offering some interesting 10-day retracements. Lots of dojis on the ETFs as well. Big breakdown still in oil, Mexico, Latin America, Brazil. Not much more to report on this. This used to be like -8 sigma, so these are all coming back strong. The mechanical auto framer trades are still now available. There's Walgreens, Walmart, Oil Exploration, and Coke. These deep discounted ones in the ETF and the Dow 30 above the line, these are the most numbers of ATRs below their long-term fair value. So you can see oil is 8 ATRs below its long-term RL270. Energy exploration, and so forth. Boeing, Coke, and Chevron still remain interesting to me. The ones down here in the bottom shelf, these are the ones that are fully valued. So Microsoft has just been Microsoft and Intel, kind of the old school large cap tech, are doing well. A lot of daily squeezes show up because Friday was an inside day on declining volatility. So and it's fallen so far from the 10-day high that a lot of these are starting to look favorable. And there's some good names in there that we know. Walgreens, Energy, ExxonMobil, Goldman, Merck, Walmart, United Tech, Morgan Stanley, Brazil. So lots to choose from. Most everything has moved over into daily spring, and I'm interested in these things that are high in the Z-score stack in spring. So like Japan, tech, metals and mining, finance, and energy. And then on the Dow 30, it'd be things like Cisco, Intel, Dow, Caterpillar, U.S. Steel. All these things that are high in the zone here means that they are closest to the summer in terms of their negative stretches. Procter & Gamble's interesting. Had a big 3-day move and with only 58 on its 10-day index, shows that there's still plenty of room to get to the top, whereas something like Travelers had breakouts on both the 3 and the 10-day, as did Treasuries over here. So when I see that big green number here, but it's still fairly low, that tells me Procter & Gamble has some room to go as well. And in that sense, real estate over here on this side at 97 and consumer staples at 85. Yeah. Market mosaics. To me, this one is key, where the slope of the RL30 has bottomed out and is now crossing over its 10-period moving average at 4 sigma below the long-term average. Anytime there's that kind of crossover that far away from long-term fair value, that has quite often been a intermediate bottom. Excuse me. So that's how I'm framing it in that way. You can see the longer historical frame here. Volatility peaking and rolling over. Just the magnitude of this move, the viciousness of the sell-off in terms of that slope. To me, the slope of the RL30 is the health of the market. That's the first thing that I look at all the time. And so when it's making this turn, that to me feels significant. The rest of these just to flash through for reference. So I want to talk a little bit about strategy. So I sort of have this view of the market. So we have the market as sort of that mechanism, that efficient mechanism that connects capital that has choices on where to spend it with business opportunities of various sizes and magnitudes and regions and complexity. And there are agents in the market who facilitate it. There are regulators who manage it and keep it honest. There are observers who comment on it, which can shift perceptions of what's going on in the pool of capital and in the pool of business opportunities. And there are power brokers who can leverage what's going on for their own purposes and cause there to be changes made about how much capital is going to be available, what kind of business regulations are there, how shall the market be regulated. So think of those as power brokers, not just politicians, but also influencers and media. People who can make a difference in the regulatory. And then recognize that in this connection between capital and business, there are other competing opportunities out there for those same kinds of pools of capital. And I've just kind of arrayed these different pools of capital in different sizes, shapes, and colors just to suggest how many different agents and actors there are in that environment. Well, we can think of actors as being the people with the capital, and the reason the market is just so interesting to me and why it's such a confounding game sometimes is that you recognize that for every actor that is represented in this pool of money, and oh, by the way, some of those pools of capital, many of those pools of capital are business enterprises themselves over here. So they are not only the target of investable capital, but they have investable capital that they in turn can act as an actor and deploy throughout this world. And there are agents in the market who act as investors as well, and regulators and power brokers and nations are also involved in that as well. So it's not a linear process. So you can say all those individual actors and in the organizations, the institutions that are in there competing around, all have these different dimensions and different arrays of that make each one of them unique. And you might think of this matrix where you have something like a risk profile, people who are based on their constraints, responsibilities, perceived options, training, experience, goals, and objectives, and their culture and their risk appetite. They might have different time horizons, short, medium, and long, whatever that means. Is this day trading, swing trading, position trading? Is this days, weeks, and months? Is this months, years, and decades? Is this generations? So every time horizon really can be interpreted differently, and just because we think of it maybe as in terms of days, weeks, and months, there's other people think of that in terms of ticks, seconds, and minutes. So that's really a relative reference. And then inside your risk profile, you almost have a global positioning of like I'm aggressive, normal, or conservative in terms of my risk appetite. And then with each bucket of money that you have, you could think about, you might have 5 buckets of money and say, hey, I got some here, maybe I got a bunch here, a large pool of capital here, and maybe some swing here, and then some day trading, or whatever it may be. So you might have different magnitudes and buckets, and so you could end up having a composite risk profile that's different than just one point on that curve, depending on the pools of capital or how you've structured your thought process. You might have different valences with all that. Well, that's why it's kind of a fool's errand to try to figure out, what's everybody else thinking? Well, everybody else is thinking all the possible thoughts. If there's a thought that can be had out there, somebody's thinking it, But to me, this starts getting into a description of what's going on inside your head, part of a self-awareness, self-understanding, and how you've structured and organized your thought process with respect to asset allocation. And so as we think about the world now, we might, if we're going to adopt sort of a short term, and hat tip to Aswan Damodaran, a world authority on valuation and a really smart guy. A lot of respect for him. With his permission, I'm sharing this stuff. No disagreement that the virus will cause the economy to go into a deep recession. Don't disagree with that. Since it's going to be shut down for at least a couple weeks, and it's more like 3 months. All of the economic indicators are going to be shocked. And then the interpretation of that will get leveraged in the media. So, really, 2 questions. How quickly will it come back? And when it does, how completely will it recover? And that's sort of the immediate response, stop the bleeding, And then the second one is, what's the long-term change to economic structure and psychology? So if we think back to this, we can think of this sort of as the short-term thing would be the transactional nature of the market. Its scorecard, is it going up or down? But then the long-term structure is what happens to the availability of capital, the willingness to put it into this market rather than other competing opportunities. What kind of structural changes are going to be made by power brokers, regulators, and agents as a response to what has happened? And then how are the opportunity space, what's that look like as winners and losers are declared and picked and supported and morphed and reconfiguring? That $4.5 trillion that's going to the big corporations is going to set up a feeding frenzy of buying less robust, more vulnerable businesses. So we're likely to see a large consolidation in a lot of industries and nations. You could even see long-term structural things like a return to the New Deal, or a return of the reverse engineering of the globalization of supply chains. That's, to me, the no-brainer. Well, if that's what that other ecosystem looks like, now when we start thinking about our ecosystem, these are the approaches that we take to navigating through that jungle of an ecosystem. starting with a learning ecosystem and a preparation ecosystem. Plan, prepare, execute, and assess. In planning and preparing so that I'm then ready to trade. And then when I'm ready to trade, I can execute it well and then assess it correctly. So planning and preparing, kind of what we're doing now. Execution, some of these elements and key mental models. Then in the assessment area, ways that we can assess how we planned, how we prepared, how we executed, and then we can assess our assessment itself. And looking at ourselves as key components and actors inside our own ecosystem. We can be thinking about the ways we learn, the ways we build capacity so that we're better as a consequence of how we learn from the experiences that we generate. And if you want to be adaptable in an adapting world, then it's your maximum sustainable rate of learning that is going to allow you to stay current and to maintain your edges and to find new ones. And then we can take a kind of a business-like approach to the things that we're doing over in here with management, where we can take a look at who's on our team and how are each of those voices, those business-like voices and the roles they play, how are they manifested in our operations? What kind of processes are we using to get better in a business-like way, using sustainable business processes like visual systems, robust systems, Kanban and Gemba approaches to craft knowledge. How well do our research and prototyping systems scale? How do we go from conception to backtesting, paper trading, prototyping, limited production, full rate production, so that we are rolling out capital consistent with observed performance in the world and real competition? And how are, to borrow the Mintzberg's ideas, how are we getting better in all three of those elements of effective leadership and management: the science, the art, and the craft knowledge? How are we systematically going about our business so that we're doing all the right things, so that we have to-do lists and certain projects and priorities, and how well we are ranking the importance, the time urgency, and therefore the priorities? What kind of work that, if that's our to-do list, how do we limit our work in progress to make sure that we can actually become efficient? And how are we keeping score on the work that's completed? That's sort of a Kanban and lean thinking approach to all the things that we know we have to do to run our business correctly, to be business-like in our approach to capital management, to the management of our learning, to the investigation of new ideas. So not just doing the things that we like to do, but doing all the things that we need to do. And then how are we aligning who we are and what our goals are with these operating processes, and then working in different time frames at the level of strategy, where we're concerned with what our purpose in life is, and our identity, and what our missions and values are that guide. And then the kinds of tactics that we employ to ensure that in everything that we do there is excellence in risk management and sustainable performance and a focus on the outcomes. And then having the operational connection between the grand visions and of strategy with the daily task of trading, and that using an operational view to connect the ends, ways, and means, and figuring out how to manage things in a certain way so that we can maintain alignment in our between our strategies and our operations. So all of those things kind of go into play. Well, if these are kind of the 600-pound gorilla, the questions that everybody's trying to sort their way through. we might summarize kind of quickly by saying, well, there's at least 4 kinds of strategies that conventional and traditional thinkers are looking at. First, looking at that world of opportunity that's out there. So if we look out in this and take our lens and focus in on all these different business opportunities with our little pool of capital over here, we're trying to figure out where to deploy it, and then trying to make decisions on, for each pool of capital, which one are we talking, which block are we talking about, and what kind of objectives are we trying to achieve, and what kind of time horizons, based on a consistency with our risk profile and our identity of who we are and all that. We could think of, 4 generic strategies, sort of like bargain basement. And this one, look for the things that have been smashed and are therefore on sale. Maybe they've lost 40 to 50%. But they have survival basics. Things like large market cap, low net debt, and maybe better than their peers to be able to survive the pandemic winter of the post-virus economy. So we're looking for survivors that, even though they've been hit, they have the residual strength. Especially if they're using that free money from the Fed to start buying up assets on the cheap, and then using their proven business processes to get into to turn that around. Maybe a riskier one is looking for stocks that have maybe even lost more than average, and which have high net debt and fixed cost, but looking at the most risky ones, saying, and just betting on their survival. And so in this strategy, we're really, this is essentially buying options on them, say, well, even though they're close to death, I don't think they're going to zero, and so then the recovery will be that much stronger. Government bailouts are kind of the wild card on here, because while it may lead to survival in some form, it might end up getting them regulated, or there might not be the opportunity for growth that you might think. So distressed equity is it's like bargain basement on steroids, that there's actual reasons to be concerned about their very survival. So something like Boeing kind of falls into that category in my view. Well, we might then say a safety at a reasonable price. You remember just a month ago we were talking about growth at a reasonable price. So safety at a reasonable price. They have 2 things going for them. They're not only best positioned to survive this downturn, but they can actually, they have ammunition in the form of capital, and money, time, capacity, potential to make the downturn work in their favor. So if they're a large market cap firm, low debt ratios, lots of cash, Apple, that have had high growth and profit in pre-virus economies, they would be good candidates. That's why something like Apple is really an opportunity, whereas I would say something like maybe Tesla might be something like a bargain basement, although they don't have much low debt, but there's an opportunity for them to buy the future on sale. Well, this is where actually, so Tesla, a better example for Tesla would be a change agent. So this one says, hey, the world's not going to end, and although they may not have the best economic posture now, but because of the anticipated rewiring in the world that we talked about on this chart, where we said, hey, the way people think about deploying their capital will change. The shape of business opportunities you can invest in are changing. The market itself and the way it's being run and regulated, observed, and manipulated is all going to change. And there are other competing opportunities for money. So whatever the shape of that larger ecosystem looks like, if you had an opinion on that, then a change agent is a bet on a company that you think is going to be better postured in the future to take advantage of those emerging trends when they come about later. So that's where something like Virgin Galactic or Tesla or that lithium battery company we talked about, or the cannabis or adult education or something like that might, or companies that are more likely to benefit from a change in national health care, as an example. So we can think about, when we think about our opportunities here, it's kind of easy to be, get locked into just the short term. Hey, what do I want to day trade tomorrow? Or what do I want to maybe start initiating some swing trades on things that are already starting to turn around, or what do I want to, buy and hold? This for me is like the U.S. steel I think about in this category over here. This one might be cut that timber or energy, or Devon Energy, for example, or the volatility trade, or short-term finance, or Boeing, or something like that. Or I might want to be very speculative and say, I'm just going to buy Boeing and forget about it for 5 years, or buy the triple Dow and say that 40 years from now in my kids' IRAs, if there's any one index that will still be around, I think I'd bet on the Dow 30 Industrials in some form. So why not buy that thing when it's on 50% sale, as an example? So as you start thinking about posturing, then the intention would be is that weekly report that we do should really give you opportunities to start thinking about different buckets of money and different approaches to trading the different time frames, and then trading inside those time frames at different degrees of leverage. And then you have, in the space now that I'm showing as yellow, this is where those core and turbo strategies now start to make sense. That if I'm looking at a combination of short and medium time frames, that the medium time frame is core and the turbo is short. This little space in between is how each of those regions can talk to each other. Maybe something like this is now the medium, the swing trade is the turbo, and then the long term is the core. So I can have regions in between there. Similarly, I might start off with some things that are or I can think about the the overlap in these different regions, that with some amounts of money I could start off with a conservative position that grows slowly into after it's earned its way, it can start paying for itself and become a longer term position. So you might end up having money that starts down here, aggressive short, then starts migrating towards long term and conservative when it's paid for with market's money. So once you start thinking of your portfolio as a set of buckets that are related, you have a meta system. This is the area where that knowing yourself and sort of identifying all these aspects of your operational environment allow you then to pick systems that allow you to operationalize the goals and objectives that come out of your unique situation. So that's why I would say I'm really excited about this talent LMS thing. So some ideas that I've had, I want to just show you over here. So in the coaching, let's see, coaching and psychology, there's the L. So I'm going to add in, I've added in a bunch of files in this section. There's a really good one from Patrick Birch. Let's see. I say it's in here, now it better be here. No, shoot. I will have one in here from Patrick Birch where he went through a series of 10 structured exercises, and I'm going to be adding in his live trading, his research weekend presentation. I thought I put that in here. Where he went through that structured approach in about a 6-week period, and then really came out of that with his brain rewired, and did a really nice job of getting to clarity on who he was and what he wants to do. And now he's working as a pro money manager and managing really all those different time frames. And so a lot of the work that he did in that course, in that presentation, which is really his black belt presentation, is really helped him. And then, so we've already got some pretty good, some meditations, some visualizations, some psychology. This one I think is pretty good. The success script and visualization. These are an adaptation of some hypnosis work that I have done for athletic performance and for teaching performance, and along with my son. So there's this is a success script, and then I suggest that you follow these steps to go through that, and then see what happens to your inner psychology when you start taking a deliberative process to shape your own mentality. We know from science that things like laughing yoga and smiling yoga, you can deliberately change your mental state by adopting a certain posture or a certain behavior, and that your body doesn't know that you're gaming it. All it knows is that when it smiles, it's supposed to release endorphins, and those endorphins change your mental state. Well, you can do that deliberately. You could have a timer set up so that every hour a bell rings, and you do 5 minutes of intentional smiling and focused visualization, and watch what happens to your blood pressure and your state of mind. So you can. So this is an exercise in that sense, to kind of get you going into the world of state management. So there's some other pretty good exercises in here already. The owl meditation is a great one for getting connected to what's most important. This one on how to work with anxiety is already paying off for Jim up in Chicago. It kind of worked for him, so I want to share that one with you. The strategic and systems. Well, first of all, I should say the boot camp. So the boot camp one is live and active right now, and this is kind of like the immediate action, how to get rapidly into the game and get things going with the most important elements of the ecosystem, how to think about learning and acquiring professional knowledge, and how we use the coaching, and then the base camp specific guidances on systems and approaches and chain trading and swing trading, and then some ideas on what we're calling core and turbo, the visual box trading, and then the multi-time frame lens analysis. That's all there. The strategic and systems thinking one turns out to be pretty slick. So I got about 145 lessons on this one, and I'll just let you scroll through here, but these are some technical things about how to map your preparation process to all the way to thinking hard about science, art, and craft knowledge. So there's a ton of the WMB strategy, auto framers, core and turbo, using statistics to structure your trading with a case example of 16R and silver, how to deal with sideways quiet channels, how to think about the risk Z concept, RLFF strategies. Jeff's Dragon and Snell and Hunting are examples of black belt presentations from live trading workshops and research weekends that show some systems in action. Specific examples like the Williams percent R versus the Tortoise NDX, the 2R battle drill, how to work with the VWAP. So these are all things that are kind of are outside of the specific systems, but they're more of like strategies and approaches. So all that stuff is available inside. I'm really happy with the way this Talent LMS is working out. And then, as I mentioned in a previous discussions, all of our daily podcasts are gonna go inside this one. So just building out each of the dailies, podcasts and speed runs, so we can see the connection between plan and prep, and then execute and assess. That's in there. And then the Forex 0.8 is up and running, and Forex 1.0, which will build on this success and improve it and make more advanced strategies in there. So those are all kind of ready to go. Some of these other ones, I'll get to them when I get to them. The first 50 nuggets is going to be one swing trader's approach to adopting our approaches now. She internalized it and tapped into her intuition and creative side to balance out her scientific accounting side. I'll go deep dives into how to read the daily and weekend reports. The flashcards are, each one of those is going to be like one snapshot that triggers a specific learning point that locks in a key concept. So that's sort of like a check on learning. And those of you who have been to the live trading with me know I carry around a bunch of those flashcards, and I review them just so I can stay centered and get back to my basics. That's like my kata, my standard forms, just everything in one page concept. An example of that one is a reminder that oops. Where is it? There we go. Oh, yeah. So here's an example of a flashcard. This is how volatility works on every time frame. You get some kind of blue normalish thing going on, and then suddenly something happens and it breaks out beyond all recognition, and volatility goes way up. Then after it crosses over its 10-period moving average, you get this long decay back into something like previous bounds of volatility. So volatility is not symmetrical. That when things get quiet, too quiet, you got to be always prepared for that sudden shock. So we use the risk Z as a way to calibrate our estimate of where we are in that sort of life cycle. An example of a owl entry and a Z3 breakout, and then a P1, and then an RLXD, and then recovering. So this is a key point. So when you see blue circles and a 2 dot, that means I should be getting long right in here on a resumption. So now I can expect, I should not be surprised if the next leg up is as long as this leg was up. So the idea behind flashcards are that they give us very specific, like here's the template of the owl, setup conditions, implementation, and then what that thing looks like. So these little one-pagers, these little snapshots are things that are very handy. So here's that same owl entry, consolidation, and then the next breakout. So to be ready for that next leg up. So the whole series, there's 100 flashcards in that deck. All the different places we can think about after a sell-off, the RLXD, the owl, the breakout of the previous Z3, all of these things are now opportunities and ways to think about. If I didn't take those entries, how do I think about this one? It can go up, it can go sideways, it can fail. And so if I can visualize all those possibilities, I can then start calibrating the sizes of moves, and now I'm operating on a structured, adaptive, statistics-based estimate of reasonable possibilities instead of wishing and hopeful thinking and emotional response. So these flashcards are a way to sort of reinforce, it's our playbook in many ways. So that's what that flashcard course will be like. A flashcard on risk. 4 bad assumptions about risk from the HBR Harvard Business Review. Assuming that taking the action is the biggest risk, when it could be that inaction might be a bigger risk of all, keeping your cash in a mattress. That if I celebrating a failure to encourage risk taking, like, hey, because I didn't encourage you to take a risk, that I should praise that. No, instead, I should be doing due diligence and professional grade judgment to know the difference between risks and gambles. And then failure to take a prudent risk is like losing out to the long-term rate of inflation. So I shouldn't be celebrating the failure to take a good risk. Believing that good entrepreneurs seek out risk. No, that managing the risks that they're encountering is what makes a good entrepreneur. It just means that they're getting in early and seeing the potential while still understanding the risk. So managing the risk is what we want to talk about. Thinking that rewarding success will boost risk-taking, it doesn't. That the way you encourage risk-taking is that you eliminate the punishment for failure. Well, if that's what Harvard Business Review concludes about businesses of all sizes and in all shapes, public and private, foreign and domestic, profit and non-profit, if that's their problem, what's that mean for us as an individual? Well, if we approach our trading process in a business-like way, we can say, how are we thinking about risk in our own trading? Is taking the trade the biggest risk, or is it a bigger risk if I don't take the trade? Because it adds the potential for future stress if the trade I wanted to take and which was properly framed, I just couldn't pull the trigger, and then it worked. Does that put more pressure on me to violate my rules next time, or what's that do to longer term? So where's the real risk? Have I mitigated my risk taking through due diligence and professional grade judgment? What's my process look like? Am I taking wild gambles simply because I equate risk with reward, or am I managing risk in such a way that I can manage the risk that I'm taking and I can manage the reward that seems to be reasonably available, and am I tipping the scales in my favor? And am I psychologically processing the results of the trade in such a way that I understand what failure means, and that recognizing the failure already carries with it the corrective information. Like when you lose money on the trade, the failure was the failure of that trade to follow through, not your failure for taking the trade, unless you did it for wrong reasons. But you don't need the extra punishment of judgment and emotional harm from yourself or from others to reinforce the information that's available in the results. So we can now think about these categories of risks that Harvard has done a nice job for us understanding the way businesses look at risk. We can look at ourselves as a business, as a collection of processes designed to have a long-term systematic disciplined relationship with the markets as a way to add value, create value robustly. Well, we can think about these four elements of risk in our own operations and draw some conclusions. So that's one of the lessons that will be in the psychology and in the systems and strategy. So there may be a little bit of overlap in those courses, but you'll know that when you see it. So I think that's everything I wanted to cover tonight, pending your questions. I'll stop the tape there, or I'll give you guys a chance for questions or comments. I still think it's to get back to the tactics for tomorrow, it's still what I said Friday night and in the speed run. It's all the usual suspects. It's the U.S., it's the basic materials, the getting the indexes and the psychology right, starting with what the futures are going to say. They were down trivially earlier today, so I'll be watching that tonight and then into the mornings. So other than that, that's all I got for you tonight. Hearing no questions, thanks for your kind attention and suffering through some of the general support ideas here. And we will see you in the chat room and in the library. Take good care.